Welcome to the Unconventional Wisdom Podcast with Ed Rempel, the show about the most effective methods to achieve financial security and freedom. Find out what really works. Insights are based on in-depth experience from a fee-for-service financial planner, tax accountant, Canada's #1 financial planner blogger, and your host, Ed Rempel. 2026 tax changes. How they affect your life and your retirement plan. There were not a lot of tax changes this year, but keeping up with the changes is important to plan effectively and to minimize your tax. So in this post, what you're going to learn is what's new and relevant for you in tax 2026. How will the changes affect your life? How will the changes affect your retirement plan? What's Ed's advice on the FHSA versus home buyers plan? What's the latest on ITF accounts and joint name principal residences? And what is Ed's view on these changes and why they were done? Okay, so the first thing is there was a small tax reduction. Now, we always like tax reductions, even the small ones. Now, so basically all of the tax rates and brackets were left the same except one. So there's a 0.5% reduction from 15% to 14.5% tax rate for the lowest tax bracket. Okay, that's for people making up to $57,000 a year. It's a reduction of 1% from 15% to 14% effective July 1st. So half the savings are in 2025 and half in 2026. The average tax rate for the lowest tax bracket is 14.5% for income below $57,000 for 2025. It saves a minimum or a maximum of about $200 a year for anybody that's earning $57,000 or more. Now, it reduces refundable tax credits by the same 0.5% amount. So if you get large tax credits, they could theoretically fully offset the lower tax rate. Okay, so therefore, they also had the top-up tax credit. So this actually makes sure that you don't pay more from the lower tax credit rate than you save from the lower tax. So now there was a lot of larger tax credits. So this could happen if you have tax credits that are more than your income after deductions. So the tax credits include, medical expenses, CPP and EI contributions, tuition, student loan interest, donations, dividend tax credit, disability and caregiver credits, pension credits, HST, and the first-time home buyers credit. So it's not unrealistic that people would actually have more in credits than taxable income. So there's an extra credit to make sure that if you have a lot of credits, it'll wipe out the savings completely, but you won't end up paying more. The second big thing is the home buyers plan increase. So it's been increased to $60,000 per person with the first repayment in the 5th year after withdrawal instead of the second. So that's all a very, very positive. So this means a couple can save up to $200,000 in accounts where they get a tax deduction for the contributions. So this includes $60,000 each they can borrow from the RRSP in the home buyers plan, and $40,000 each can contribute to their first home savings account, FHSA. That's $200,000 total. So now my advice here is that essentially everyone should use the FHSA and get a tax-free withdrawal. But try not to use the home buyers plan if you can get your 20% down without it. Since you're borrowing from the RSP at the rate of return that your investments in your RSP make. If you're an equity-focused growth investor like most of our clients, that rate of return is likely much higher than your mortgage rate. So it's better if you could save up somehow and get your down payment and then just get a bigger mortgage. That's better than using the home buyers plan if you don't need it. Now, this is welcome given how very hard it is for young people to buy their first home today with how much house prices have risen. I feel for young people and any first-time home buyers today who need both a large down payment and to qualify for a large mortgage. House prices surged for a few reasons, but mainly it was driven by a classic imbalance, demand outpacing supply. So demand for homes from a larger population, mainly because of higher immigration, was 3 to 5 times higher than supply, since municipalities resistant to change continue to be restrictive with building permits. Now, the home buyers plan increase is welcome, but does show how slow governments are. It should have been done a few years ago, since the large price increases generally happened from 2019 to 2022. House prices actually came down significantly in 2025 and are expected to decline further in 2026. Now, we finally have some relief in the Bear Trust debacle. Now, the Bear Trust debacle is what I call it, but actually quite a few other people have called it as well. But it's not 100% relief, but basically it works. So the new rules on the Bear Trusts in 2023 would have required onerous additional tax reporting for many people, except that every year since the government announced the rules won't be enforced this year, but remain for next year. So every year at the last minute, the government stopped it and said, okay, don't worry about it this year, but the rules still exist for next year. Now, the new rules affected parents saving for their kids in trust for accounts, it's ITF accounts, and family joint ownership of real estate, like principal residences, such as parents adding their name to kids' mortgage to help qualify for a home, or adult kids going on title for aged parents for estate planning purposes. Now, it was called a debacle because the first draft would have applied to millions of Canadians, most of which were unaware. And the announcement of the extra filing not being required this year was made on the deadline day for 2023 and late in the years since then. We didn't know during much of any year what would have ended up being enforced. And that is one of the tax principles that's supposed to be followed is you're supposed to know what the rules are ahead of time so you can plan your life properly. We finally have some relief. Now, the Bear Trust onerous reporting is not required for 2025 and is still required for 2026, just like prior years. But the areas we were worried about for our clients will essentially be exempt. So for interest accounts, ITFs, with parents saving for the children, they are effectively exempt if the value of each account is less than $250,000 for the full year. Before it was $50,000, which is an issue. $250,000 is pretty big. Now, the wording is a bit unclear, but appears to be for each parent and child. For example, a family with 2 kids could have 4 separate ITF accounts and up to $250,000 exempt for each account if the father and the mother each have an ITF account for each kid. So, now, family joint ownership involving related people with principal residences are exempt, which includes parents on a child's mortgage to help them qualify for a mortgage, and children on title of their aging parents' home for estate planning purposes. So now all the rules are proposed and not planned yet, but it looks like all the issues that we were concerned about are probably not going to be an issue. So now we are part of the way through 2026 and don't know for sure the 2026 rules or how they might be applied, but it appears the Bear Trust rules should essentially not apply for our clients and for most people. It would just apply still for very complex situations. For more unconventional wisdom insights, follow this podcast and share it with your friends. I sometimes refer to a chart or image. Don't worry, if you want to see the chart, it's on my YouTube channel in this video with the same name. You can be the first to receive all my new podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help. You can request a free 30-minute consultation at edrempel.com/talk or share feedback and topic ideas at edrempel.com/feedback. The next change is there's a new second alternative minimum tax. Now, many of you may not have known that we have an alternative minimum tax, but now there's a second alternative minimum tax. So now the new AMT, this means your tax returns are calculated 3 times. You probably don't know it, but they are. So once the normal way and once for each of the 2 AMT rules. Now you pay whichever of the 3 is the highest tax. The new rules mostly affect large capital gains and large donations. So you may get this tax back over up to 7 years if the high capital gain or donation is a one-time event. Now, we're not fans of it because it can make tax significantly more complex. Taxes are far more complex than 10 years ago and seem to get continuously more complex. Major tax reform has been needed for decades and has not been done since the 1960s. In many cases, the government may not even collect any more tax since the taxpayer might get it all back in future years. So they're going through all this for possibly little or no tax. Now, who's affected by the second AMT? Now, this is large capital gains, which are usually on real estate. So such as when a cottage or rental property bought many years ago is sold. They can also be on large stock options for top employees or stock market gains. Stock market gains tend to be larger, but investors rarely hold specific investments for decades, and they can easily sell a bit each year to spread out the gains, so they can generally avoid it. Real estate is all sold in 1 year. Now, large donations are generally older, wealthy people supporting charities, often using some advanced, commonly used planning methods. So now the AMT change does not allow claiming tax credits for flow-through shares, which are commonly used for large donations. Now, I have a video on that, how to donate 10 times more with the donation flow-through strategy. So this is expected to reduce large donations for many charities. And actually, quite a few charities have been worried about it. This is often where they get their big amounts from. And it seems like an unusual thing for government to be attacking, but that is in effect. So looking at these 10 times donation plans, they're considerably more tricky, but there may be ways to still deal with those. Now, on top of those, there's a few just technical rules. So I'll give you the three, kind of the main one. One is that they've removed the luxury tax on boats and airplanes, but not on cars over $100,000. So now luxury boats and airplanes bought by Canadians were mostly made here in Canada. So this affected those manufacturing industries a lot. It still applies to luxury cars, which are very often not made in Canada. So they eliminated the federal underused housing tax. It was a UHT. So the underused housing tax, the federal one, is gone. Now, this was a 1% annual tax on the value of vacant or unused residential properties owned by a non-resident, non-Canadians. This has been eliminated, effective for 2025 calendar year. It was deemed inefficient and too costly to administer. They passed the federal foreign buyer ban, so the tax was essentially redundant. Third change is more technical. So the family trust 21-year rule, the change is that they can't transfer the family trust to a corporation owned by another trust. So this is a technical issue for complex tax situations that would apply to few people. Okay, the next change is there's a new Canada Disability Benefit, CDB. So there's a host of benefits for disabilities, and now we have another one. So now this benefit, that's a new benefit for working age Canadians, age 18 to 64, eligible for the disability tax credit, providing up to $2,400 per year. That's a $200 per month maximum, and it's income tested. So people who already have the disability tax credit can apply separately for this new income benefit with a maximum $200 per month tax-free, effective July 1st, 2025. For single people with a net income less than $23,000 and married people with family net income less than $32,500. The benefits reduced by 20% of your net income from $1, except employment income when you can earn at least up to $10,000 before having had the benefit reduced. So it's $200 a month, and actually quite a few people most people have at least some income, so they probably wouldn't get all of that. Next interesting area is the whole area of CRA service, which has gotten really bad the last number of years. So service for calls to CRA continues to be slow. They hired more employees and now answer about 70% of calls. You'd think they'd answer 100%, but no, 70%. However, there has been no attempt to simplify tax rules that have become significantly more complex the last few years. And in my opinion, that's the main reason why it's so slow, because the whole tax act has become way more complicated. So training of new employees has been inadequate. For general individual tax questions, So like non-personalized advice on rules, deductions, or filing, agents provided accurate answers only 17% of the time based on a study. This means information was incorrect or incomplete in 83% of cases tested. So now CRA now generally takes 4 months to respond to reassessments, which is far too long. If your tax return is actually between 4 and 8 months, if your tax return is filed in April and you get a reassessment in May and respond in June, it might be the next tax year before CRA responds. We run into this sometimes too. We have one right now that's in month 7 and still haven't heard back from them. You could be into a new year and still not have had your tax refund for the last year. So the bottom line, if you have tax questions, ask your accountant or your tax specialist, or if you're a client, ask us. Don't ask CRA. Now, the last thing I want to talk about is there were several expected tax changes that that were widely expected and the government had even talked about that did not happen. So first one is the RIF minimum withdrawals were not reduced. So this would have helped retirees plan to have their RIFs last longer. This will be needed as life expectancy rises with new medicine and AI. It sounds like life expectancy may rise dramatically in the next 5 to 10 years, with AI expected to find cures for most major diseases and possibly even figure out why our cells age at all. The government has promised they would reduce the RIF minimum withdrawals, but they didn't do it. Also, the capital gains inclusion rate from 50% to 67% was canceled. What a relief that is. This would have been a highly negative tax increase for our clients and for the economy. There was a lot of buzz from wealthy people planning to look into complex tax planning or leaving Canada. The rule was considered unfair because large capital gains tend to be on real estate where the growth is mainly inflation. And the last one is the Canada Entrepreneurs Incentive has been canceled. Now, this was related to the capital gains inclusion rate increase. So it was canceled when the inclusion rate increase was canceled. It was intended to reduce the cost of the higher capital gains tax on specific types of entrepreneurs when they sell an ongoing business. All right, so those are the major changes for this year. Thanks for listening. So what you learned is what's new and relevant for you in tax 2026, how will the tax changes affect your life, how will the changes affect your retirement plan, what is Ed's advice on the FHSA versus home buyers plan, what is the latest on ITF accounts and joint name principal residences, and what is Ed's view on these changes and why they were done. So thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog for a full-service financial planner in Canada. It's just edrempel.com, my name, or it's unconventionalwisdom.ca. If you use the unconventional wisdom, make sure you use .ca because we're in Canada. If you're interested in potentially talking to us about being a client, we offer a free 30-minute consultation. It's just edrempel.com/talk. You can, if you subscribe to my blog, podcast, or YouTube, then all that happens is you will get a notice. You'll get a notice once a week when my new post comes out every Thursday. My podcast is edrempel.com/listen, and the YouTube channel is edrempel.com/watch. Thanks for listening, and we'll talk to you next week. Thank you for listening. For more unconventional wisdom insights, follow this podcast, give it a review, and share it with your friends. Be the first to receive all my podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help, and you can request a free 30-minute consultation at edrempel.com/talk. I often cover listener questions, so if you have a burning question or topic on which you'd like to hear unconventional wisdom, please ask or share feedback at edrempel.com/feedback. See you next week.